Hi everyone. So I wanted to do another video on aggregation, and this time going through a different fact pattern, that being what happens when you have an investor with gains but then an investor who also has losses, or put it another way, someone who has positive disparity and negative disparity. So just to go over the fact pattern, currently we have 3 investors in our partnership. And once again, this is a trading partnership who has assets, over 90% of which are trading assets. So on their balance sheet, you would have mostly stocks and bonds. And we have GAAP income or book income being allocated 50%, 25%, 25% to the investors. And taxable income, book income, being 100, taxable income being 75. And it's going to enlarge this a little. And we have our current year disparity. Now, what would happen is that if you have a book tax difference, that means that what you've economically earned and what you've been taxed on have different, are kind of going in different directions, or one may be ahead of the other. And by ahead meaning that one may be higher than the other. So in this case, one investor has a historic GAAP capital of $75 and historic tax capital of $50, and investor B has the same fact pattern. This means that economically, this investor earned $75, but only got taxed on $50. So that means he needs to get taxed an additional $25 in order for book and tax to equal each other. So in a situation like this, the disparity with all investors, or the book tax difference with all investors, are all in line, meaning that they're all positive. Each investor needs gains. But in a situation where someone's tax capital is higher than their book, so let's say in this case, the investor has tax of 100 and GAAP of 75, that means that this investor has been overtaxed. That means that he's paid tax on 100, but has only economically earned 75. That means through the life of his investment, then this investor will eventually have to get allocated $25 of loss in order for tax to equal GAAP. So in a situation like this, where we have 2 investors that have positive disparity and one who has negative, we go through the pattern of how to allocate the aggregate, or the 704C income, which in this case is $50 of long-term capital gain. So going through the example that we have, first we still allocate non-aggregate income, or our $25 of non-704C income, which could be line 1 ordinary income, line 2 rental, interest, or dividends. And we allocate that using the book percentage, which is 50%, 25%, 25%. So we'd still take our 25 and multiply it by the book income percentage. Once we do that, we get our build-up, which is our book income minus our non-aggregate income, or our book minus our non-704C. What then happens is we take that and add it to our beginning disparity. So in this case, this year the investor needs $38 of gain. Previously he needed $25 of gain. So in total, he needs $63. This investor has $19 of book tax difference, doesn't have any beginning disparity, so it needs $19 of gain. This investor had $19 of current year book tax difference, but has negative $25 of beginning. So that means that in year 1, this investor needs $25 of loss. This year, it needs $19 of gain. So net is that it needs $6 of loss in order for GAAP and tax to equal. What that does is we have investors who are in different positions. 2 who are in a gain position, 1 is in a loss position. When trying to figure out how to allocate the $50 of gain, we'll split the tentative disparity, and tentative disparity again is going to be build up plus, currently it's going to be build up plus beginning. So we split tentative into positives and negatives. In this case, the two positive numbers equal $81. The negative is -6. And what we do is derive a percent based on the positives and negatives. So 63 over 81, and then 19 over 81, and negative is going to be -6 over -6. Now what this does is that we split investors into two categories. And then we just figure out if we have $50 of gain, how are we going to allocate it? Because the investors are split into positives and negatives, we would take the $50 and multiply it by the positive tentative percent. Because we're trying to allocate income in a way that diminishes book tax difference in the highest way possible, what we do is take the 50 and multiply it by 77%, 50 multiplied by the 23%, and the $50 goes to these two investors, 3/4 of it going to one investor, 1/4 of it going to another. The key thing to look at here is that $0 goes to the investor who needs losses. That can create a weird scenario where the three partners in the partnership could all share in the non-aggregate income, so they'll all share in potentially line 1, 2, 5, or whatever, but long term is only shared between two investors, the old one and the new one. So this investor here won't get any aggregate income at all. So in this situation where we have positive and negative, you split the two and then you allocate it in that fashion. Total positive disparity was 81, and we had $50 of gains to allocate. So the book tax difference that's cured, 81 that's necessary, and then 50 that's cured, leaves us with a book tax difference that remains of $31 that needs to be cured. So these investors will need investor A and C will need $31 combined in order to get their book tax difference to 0. Or put another way, if it had $31 more, then it would eliminate their book tax difference. Hope this helps. We'll go through another example with a different fact pattern as well.